Warren Buffett's retirement investing framework might be the greatest ever devised. Own fortress businesses, collect growing dividends, never sell, and sleep well at night. Now, nobody's arguing with that, but here's what most people don't tell you about it. While the framework itself is brilliant, the way people actually apply it, that's where things actually break down and it doesn't quite work. Now, when we ran several of Buffett's most popular retirement picks through a 115 factor analysis, a number of them graded out as just a C. Not dangerous, not broken, just not where the best opportunity sits right now. So today we're going to do something a little bit different. We're actually going to keep everything that Buffett taught us, right? The long time horizons, the obsession with durable moats, the discipline around cash flow and dividends, and we're going to apply it to stocks that are actually an A or a B rating right now. So we're using the same philosophy, but we're getting better entry points on these stocks. Hi, I'm Jacob Wade. I'm a financial coach for high income earners. And if you like stock analysis videos like this one, just hit that like button below for me so I know to make more videos just like this for you. And before I get into stocks, just a quick reminder, I'm presenting data here, but your investment decisions are your own. So always do your own due diligence, please. Okay, so if you want to understand how Warren Buffett thinks about a truly great business, study his relationship with Moody's, ticker symbol MCO. Now, when he first invested in it, he didn't actually go looking for it. Berkshire Hathaway, his holding company, acquired a stake in Moody's almost by accident. Now, Moody's was spun off of Dun & Bradstreet back in the year 2000, and Buffett suddenly found himself owning a piece of one of the most extraordinary businesses that he'd ever encountered. And of course, he's held it ever since. At one point, Berkshire owned nearly 20% of Moody's. He's called it one of the best businesses he has ever owned, full stop. And listen, it's easy to see why. Moody's sits at the center of the global debt markets. Every time a government or a corporation or a financial institution wants to borrow money, they almost certainly need a Moody's rating to do it. There are really only three firms that matter in this space. That's Moody's, Fitch, and the S&P, Standard & Poor's. And that dominance has been essentially unbreakable for over a century, over 100 years. Now, the barriers to entry are not just high, they're nearly vertical. You cannot replicate 100 years of credibility overnight. So they have a great moat like Buffett likes. So with all that, why aren't we recommending Moody's right now? Well, because price matters and timing matters. And we ran Moody's through our 115 factor Zen ratings system, and it came back rated just a C. It's sitting at just the top 40% across more than 4,600 stocks that we cover. Now, its momentum and sentiment grades are a D, ranking in the bottom fifth of stocks that we track. Its value grade is below 70% of the 4,600 stocks in our system, meaning the stock may not be a screaming deal. The business may be strong, but the entry point just isn't compelling. Buffett got into Moody's at a fraction of today's price. So for those of us trying to buy something today, the math just looks different. Now, here's where it gets interesting. There is a company operating in the exact same world as Moody's, financial data, ratings, investment research, that currently rates a B in our Zen ratings system, ranking in the top 16% across our entire coverage universe. It scores higher than Moody's on nearly every dimension that we measure. That company is Morningstar. Now, Morningstar is the infrastructure of the investment research world. Their ratings and data are embedded into the workflows of financial advisors, asset managers, retirement platforms, and individual investors across 29 different countries. So when a financial advisor recommends a mutual fund to a client, there's a very good chance that a Morningstar rating is sitting behind that recommendation. And when a pension fund evaluates a bond, Morningstar's data is often in the room. This is a subscription-based recurring revenue business with the kind of customer stickiness that most companies can only dream about. So once a financial institution builds the Morningstar data right into its systems, ripping it out is painful, expensive, and risky to that company. That is a moat that Buffett would recognize immediately. Now, the other thing is the timing is particularly compelling right now for Morningstar. The global wealth management industry is in the middle of a structural expansion, as it were, more assets under management, more regulatory pressure for transparency and due diligence, and a massive wave of retail investors that are entering the market who need exactly the kind of independent research that Morningstar provides. And the demand for what they sell, it's not cyclical. It actually grows with the complexity of the financial financial world, and that complexity is only going in one direction, as we all know. Now, what you might not know is Morningstar is also quietly building out its credit ratings business, expanding into territory long dominated by Moody's and S&P, while simultaneously growing its data licensing and analytics platform for the institutional clients. So these are long duration growth levers that the market is not yet fully priced in. Now, on the analyst side, Morningstar has a limited coverage but positive view. Jeffrey Silber from BMO Capital, a top 18% analyst, has a buy rating for Morningstar, and his target price indicates a nearly 15% potential upside from current levels. And it's very similar to our Zen Systems valuation of the company as well. And when you look at the actual Zen Ratings data, the picture gets even more interesting. Morningstar's AI grade comes in at a B, which is ranking it in the top 7% of all stocks. Now, our AI model analyzes subtle patterns in market data to anticipate future price movements. And right now, it's giving Morningstar one of the strongest forward-looking signals in the entire financial sector. Now, its sentiment is a grade B, which is the top 8%, and that measures what smart money is actually doing. That means institutional positioning, options activity, insider behavior. And a score this high actually tells you that sophisticated investors have already found the stock and are bullish on it. Now, the value grade is a B, ranking it in the top 20%. That means after a volatile year behind, the price is actually at attractive levels currently. Now, the Zen rating system also pegs Morningstar's fair value at over $200 against the current price of around $170, which gives you meaningful upside before you've even looked at the analyst targets. Now, one risk worth naming, honestly, is the momentum grade of a D, meaning the stock has been under price pressure and hasn't shown near-term buying strength. For investors focused on short-term price action, that is a real consideration, but momentum tends to be sort of a lagging signal, not a leading one. The AI grade, the sentiment grade, the value grade, and the analyst conviction are all pointing in the same direction, and stocks often look the most uncomfortable right before they move. Morningstar is a Buffett quality business in a Buffett quality sector at a price that actually makes sense right now. So the upgrade from Moody's to Morningstar isn't really a departure from investing philosophy, it's the philosophy applied with better timing. Now, if you like stock analysis like this, make sure to hit the subscribe button below and hit that notification bell so you're notified every time we come out with a new video so you don't miss anything. Okay, if you want to understand conviction in a business, look at how long Warren Buffett has held American Express. We're not talking years, we're talking decades. Now, Buffett first bought New American Express back in the 1960s, and Berkshire Hathaway now owns roughly 20% of the company. He's called it irreplaceable, one of the core pillars of his portfolio. And honestly, the business absolutely earns that reputation. American Express operates as a closed loop network, meaning it's both the card issuer and the payment network itself. That gives it something incredibly valuable: control over the entire transaction. It sees all the data, captures more of the economics, and builds deeper relationships with its customers. And those customers matter. American Express has built a brand around affluent, high-spending users, a base that tends to be more resilient in downturns. And that combination of pricing power, loyalty, and data advantage is exactly the kind of moat that Buffett looks for. So with all that, why aren't we recommending American Express right now? Well, because even great businesses can be fully priced. And when we run American Express through our 115-factor Zen ratings system, it comes back at a grade C, just in the upper half of the list. Now, there's no major red flags, but no edge either. The stock has had a strong run, and at current levels, the numbers just suggest that you're paying a fair price for a great business, but not getting a compelling opportunity, and that's where the upgrade comes in. Now, there's another company operating in the same global payments ecosystem, but with a different model, and right now, honestly, a stronger setup. That company is MasterCard, ticker symbol MA. Now, MasterCard currently holds a B rating in our Zen ratings system, placing it in the top 20% of all stocks that we track. And the business model is even cleaner. MasterCard is just a pure payment network, the toll road of global commerce. It doesn't issue cards, it doesn't take credit risk, it simply processes transactions and collects a fee every time money moves across its network. So whether the economy is booming or slowing down, whether consumers are paying their credit card bills or not, MasterCard still gets paid. So that's an asset-light, high-margin model with global scale built in. And the timing here is critical. We're still early in the global shift from cash to digital payments, especially in regions like Southeast Asia, Latin America, and Africa. So that's not a short-term trend. That's a multi-decade transition that's happening. And on top of that, MasterCard is expanding into areas like business-to-business payments and open banking, both massive underpenetrated markets that could significantly expand its total addressable market. Now look at the Zen ratings breakdown here. MasterCard scores a B overall, strong across the board. Its financials is exceptional with an A grade. And the company is in the top 30 companies among 4,600 stocks in this segment. The strong financial profile can be attributed to the company's exceptional margins and return on equity. Now, its safety grade is a B, ranking it in the top 6%, meaning the balance sheet is extremely solid with minimal financial risk. Now, its AI grade is also a B, ranking in the top 6% of our stock universe as well, which reflects favorable forward-looking signals based on patterns in market data. So in plain terms, MasterCard is a strong business with a strong balance sheet and supportive forward-looking indicators. Now, on the analyst side, the picture lines up. Nearly 95% of analysts covering MasterCard recommend either a strong buy or a buy. The average target price points out a nearly 30% upside potential from today's share price. And even the lowest target price indicates a potential of high single-digit return potential over the next 12 months. Now, top analysts share the same positive view. Ivan Feinseth from Tigris Financial, a top 4% analyst, set his target price over 45% higher than current levels. Another top-tier analyst, Paul Golding from Macquarie, has buy recommendation indicating over a 30% potential return. Now, there is one risk worth mentioning, and that's regulatory. Governments, particularly in Europe and increasingly in the United States, have scrutinized interchange fees and the economics of payment networks. That is something to watch out for. But even with that pressure, MasterCard's global scale and embedded position in the financial system make it incredibly difficult to displace. And this is where the framing matters. Now, Warren Buffett has publicly praised businesses like MasterCard for exactly these types of moats. So moving from American Express over to MasterCard isn't abandoning the philosophy, it's applying the same philosophy with better timing, stronger ratings, and a cleaner current setup. Now, before our last replacement here, a quick reminder, every Monday, Wall Street Zen's editor-in-chief, Steve Reitmeister, does a live market analysis, and you can actually join him for free. He walks through not just what he's buying and watching, but exactly how he's finding these opportunities so you can replicate the process yourself. He also shares his handpicked stock of the week, where he combines the power of the Zen Ratings model with over 40 years of investing experience to find ideas that you won't hear anywhere else. It's called the Wall Street Zen Live Training Session. It's completely free, and it's this coming Monday at 7 p.m. Eastern Time. Now, you can sign up at wallstreetzen.com/live. There's also a link in the description below, and you could just scan the QR code on the screen right here if you just want to jump in right now. Now, this next one tends to surprise people a bit because when you think of Warren Buffett, you probably don't think of dialysis clinics. But Berkshire Hathaway actually owns nearly 40% of DaVita. That's not a small position. That is conviction in this stock. And Buffett is pushed right up against regulatory ownership limits because he believes so strongly in this business. And once you understand it, it's going to make perfect sense. Now, DaVita operates dialysis centers across the United States. Now, kidney failure happens, and it's not cyclical. It's not discretionary. It just happens. And patients need treatment multiple times per week for life with this. And that creates one of the most reliable recurring revenue streams that you can find in healthcare. High demand certainty, high switching costs, durable cash flows, classic Buffett characteristics. Now, here's what's interesting. When we run DaVita through our Zen Ratings system, it actually comes back relatively strong, a B rating. This is not a broken company. But when you look deeper, you get a lot of C grades. Financial and growth both sit at a C. Momentum and sentiment grades are also a C as well. Now, our proprietary AI component indicates similar weaknesses. This is a mature business, stable, predictable, but not really accelerating. The financials are not promising. And now it's not a broken company for sure, at least for now. So this isn't really about replacing something weak, but it's about upgrading from good to exceptional. And that upgrade is to move to Aveanna Healthcare, ticker symbol AVAH. Now, Aveanna currently holds an A rating in our Zen Ratings system, placing it in the top 1% across 4,600 stocks that we cover. That's one of the highest rated setups you're going to find anywhere. And importantly, it's built on a very similar underlying thesis. healthcare demand that simply doesn't go away. But the delivery model here is different. Now, Aviana provides home based nursing care primarily for medically complex patients who would otherwise require hospitalization or institutional care. Now, think of it as a pressure valve for the healthcare system. Hospitals are very expensive, capacity is super limited, and increasingly patients are being pushed toward lower cost care settings. Now, Aviana is positioned directly in that flow, and the timing here is powerful. Two major tailwinds are converging at once. Now, first is just demographics. An aging population is driving sustained long term demand for in home care. And second is economics. Insurance providers and Medicaid programs are actively incentivizing home based care because it's dramatically cheaper than hospital stays. So you have a demand that's increasing, and payers are pushing in the same direction. That alignment matters. Now, there's also a niche advantage here I want to talk about. Now, Aviana has a strong presence in the pediatric home healthcare space, a highly specialized area with significant barriers to entry. You don't build that kind of network overnight. So that's another Buffett like moat around this business. Now, let's look at the actual Zen ratings here. Aviana scores an A overall, again, in the top 1% in our stock universe. The stock carries a value grade of a B, ranking in the top 7%, which suggests it's attractively priced relative to its fundamentals. And its growth grade is also at a B, placing it in the top 10% and indicating strong business expansion. Now, safety and financials both come in at a B as well, reflecting a solid balance sheet and overall business quality. And lastly, a sentiment grade of B signals that institutional investors are already recognizing the company's strengths and allocating capital accordingly. So you're not just getting a good story with AVAH, you're getting strong numbers. And on the analyst side, Wall Street's view aligns with our Zen ratings system, with overall coverage pointing to a buy recommendation. The average price target actually suggests more than a 40% upside, while even the most conservative estimates implies roughly a 20% potential gain in the next 12 months. And taking a closer look at analysts, AJ Rice of UBS, ranked among the top 11% of analysts, he actually set a price target that indicates over a 50% upside from current levels. Now, I will say there are some risks to acknowledge here. Aviana is a smaller and less widely followed company than DaVita, which means it could be more volatile. And reimbursement rates, particularly from Medicaid, are a key variable in the business itself. Those actually matter. But even with those risks, the setup is compelling. So again, this is not a departure from Buffett's thinking. It's sort of an extension of it. It's the same focus on a durable healthcare demand and the same preference for recurring revenue, but it's just applied to a company with honestly stronger current growth, better valuation support, and a higher overall rating. You're going from a B to an A. That's an upgrade. Now, today, we didn't just look at great companies, we looked at better opportunities. Moody's to Morningstar, right? American Express to MasterCard, and DaVita to Aviana. And here's the key about the whole thing. This isn't about abandoning quality companies. It's about upgrading them using better timing, stronger data, and higher rated setups. And meanwhile, the names that everyone already owns, many of them are sitting right in the middle of the pack. And that gap, that's going to be your edge as an investor. Now, if this video helped, drop a comment below with which upgrade you found the most interesting. And if you want more stock insights like this, check out this video right here from Wall Street Zen's Steve Reitmeister, where he shares 4 AI tech stocks priced under $5 that insiders are buying right now.